Hello, everyone. I am Kim Hughes, and this is the January 25th edition of Sane Crypto Live. If you are listening to this after the fact on the replay or maybe over on YouTube, if you would take just a second and do me a favor in the comments down below. Just tell me a little bit about yourself, specifically, where are you from, and what is your interest in crypto assets? Is it just as an investor, which is the end of the spectrum that I fall on, or are you more interested in the technology and the social implications, or somewhere in the middle? So today's topic is why investors suck at investing. But the good news is we're also going to talk about how to fix it. So this topic speaks to our sixth principle of investing, all of which you can find on the website at sanecrypto.com. But number 6 is we have met the enemy, and she is us, meaning we are typically our worst enemy. So that's what we're going to talk about today. I had a webinar last night. It was awesome, if I do say so myself. And prior to webinars, I always ask the registrants to fill out a super quick survey. And there was one survey response in particular that just nailed this issue. In fact, I'm going to switch over to the slide deck so that you can see it. There we go. This person said, I have Bitcoin. I was in when it went up over 19,000. I got scared yesterday and sold when it got to a low of 9,000. Bought it back when it started back up. Should have waited. Biggest question is when to buy and sell, or just hold, but to when. Okay? So if this is you, don't feel bad, because you can't help it. What most people do, because their prehistoric lizard brains are hardwired from millions of years of evolution, is sell when others are selling and buy when others are buying. This herd instinct makes complete and total sense if you're a caveman. If you and your buddies are out hunting woolly mammoth and there's a rustling in the bushes, back there, and one of your buddies starts to run, you don't stop to wonder what he was running from. You run like hell, right? So there's no downside to running. Worst case, right? You're a little bit out of breath and you're like, hey, what were we running from? Okay? But best case, if you were wrong and there was a saber-toothed tiger behind the bush, then you just got taken out of the gene pool. So this is how our hardwiring works, and it has served us well as hunter-gatherers. Problem is, it's just not so useful today. So there's a study called the Quantitative Analysis of Investor Behavior. I know part of that covered up by my video, but this is done by a research firm called Dalbar. They've been doing it for over, like 30 years, something like that. And what they do is they look at a 20-year rolling window. This particular window was the one ending in December 2015, but it doesn't matter because it always looks essentially the same. And what they do is they quantify the effect of investor behavior, hence the name, on returns. So if you look at this, we can just go from left to right. You see that over that 20-year period, the S&P 500 had a pretty average return of 8%, 8.19% specifically. So if all you had done is bought an low-cost S&P 500 index fund at the beginning of that 20-year period and held it for 20 years, your return would have been 8%. That's all you had to do to get that beta from the market. And yet, if you look, the average stock investor, that's what equity means, okay, only made 4.67% over that period of time. What accounts for the difference? Okay, buying and selling. Bond investors did even worse. If you had bought and held for 20 years the Barclays Aggregate Bond Index, you would have made 5.34%. Okay, but the average bond investor, which is what fixed income means, only made 0.51% over that period. They didn't even keep up with the rate of inflation. Okay, so what this chart tells us is that investors suck at investing because of this hardwiring in our brain, which makes us herd bound. Fear and greed cause us to buy tops and sell bottoms and do it over and over and over again. And that's what gives us this result, which is why in both of my investment methods, the one I invented 20 some odd years ago for stocks and the more recent Sane crypto system, we have built in predetermined points at which we sell. And it is always as the price is going up. Never, never, never as it is going down. Okay? With equities, it's actually a lot easier. With stocks, we have it set up so that the stock just sells automatically. We have no choice in the matter because we've sold call options against it at the strike price where we want to, at our predetermined exit point. So if it passes that, it just automatically gets exercised and you don't have a chance, any opportunity to screw it up. Now, with Bitcoin, we don't have those advanced tools yet. I think they're coming. So for now, it's even harder. The swings are bigger and therefore our reactions are more extreme. And we are left having to rely on ourselves to hit, even though we've got those predetermined points, that were decided on in advance, we have to rely on ourselves to hit the sell button at those predetermined points, which is a lot easier said than done because, of course, as soon as it's going up, you think, oh, no, I'll just hold on a little bit longer and try to make a little bit more. Fear and greed are your worst enemy, okay? That's why investors suck, and that's how you fix it. So I hope you found that helpful. Oh, by the way, yeah, that's what it looks like in our Sane. I meant to show you that. That's what it looks like in our Sane crypto framework. Okay. That's this section right here. So I hope you found that helpful. If you'd like to learn more about the Sane crypto framework, you can find this and a lot more on my website at sanecrypto.com/system for this part, for this slide. Remember, disclaimer, everything I have said is for educational purposes only. Nothing should be construed as investment advice. Past performance is no guarantee of future results. All investments involve risk. You know the drill, especially this one, okay? Could go to zero tomorrow. We hope it doesn't, but it could. So do not, under any circumstances, invest money that you cannot afford to lose. Thanks for listening today. I am Kim Hughes, and I will be back tomorrow with another edition of Sane Crypto Live. Until then, may the crypto gods continue to smile on us all. Bye, guys.